Hey there, fellow investors. Welcome to Nomad Finance Hub, where we break down essential finance concepts that will help you build your wealth. I'm your guide today, drawing from years of hands-on experience managing billions in assets. Over the course of these videos, you'll learn the concepts that allowed me to travel the world with my family while compounding wealth. Today, we're diving into understanding business cycles and their impact on your portfolio. By the end, you'll know how to spot these cycles and understand their effects on investments. Let's get started. First off, what exactly is a business cycle? It's the natural ebb and flow of economic activity over time, typically lasting from a few years to a decade. Economists break it down into four main phases: expansion, peak, contraction, and trough. Imagine it like the rhythm of a journey. Sometimes you're cruising through smooth conditions, other times hitting turbulence, but you always observe and adapt. To really grasp this, let's explore each phase in detail, starting with the basics of how these cycles are measured and why they've been a cornerstone of economic theory since the early 20th century, when economists like Joseph Schumpeter and John Maynard Keynes began formalizing ideas around economic fluctuations. In the expansion phase, everything's booming. GDP is growing, unemployment is low, consumer spending is up, and businesses are hiring and investing. This is when stock markets usually rally, inflation starts to creep up, and interest rates might rise as the Fed tries to keep things from overheating. This phase underscores the alignment of economic factors for strong performance. To elaborate, GDP, or Gross Domestic Product, represents the total value of goods and services produced in an economy. During expansion, quarterly GDP growth might hover around 2 to 4%, signaling robust health. Unemployment rates could dip below 5%, encouraging more spending as people feel secure in their jobs. Businesses respond by expanding operations, perhaps building new factories or launching products, which further fuels the cycle. Inflation, the rate at which prices rise, often accelerates here because demand outpaces supply. Think of it as too much money chasing too few goods. Central banks like the Federal Reserve step in with gradual rate hikes to cool things down, preventing bubbles. This phase can last several years, as seen in the long expansion from 2009 to 2020, where technological advancements and low rates drove sustained growth. Now, why does this matter for your portfolio? During expansion, growth stocks in tech or consumer sectors often shine because companies are expanding and profits are soaring. If you're holding equities, this is prime time for appreciation. But bonds, they might take a hit if rates rise, since bond prices move inversely to yields. This phase highlights how rising economic activity can boost certain asset classes while pressuring others. Expanding on this, consider how corporate earnings reports during expansions show surging revenues, which can lead to higher stock valuations. Tech companies, for instance, might see their share prices climb as innovation drives demand. Think of the rise in software and e-commerce firms during booms. On the fixed income side, as yields increase, existing bonds with lower coupons become less attractive, illustrating the importance of duration in bond holdings. Overall, expansions teach investors about the interplay between economic growth and asset returns, showing how sectors like technology and consumer discretionary tend to outperform, while more stable areas like utilities lag behind. But expansions don't last forever. We hit the peak, that turning point where growth maxes out. Indicators like high capacity utilization, surging inflation, or inverted yield curves signal trouble ahead. Ports get congested, wages spike, and the economy starts to feel the strain. For portfolios, this is when volatility creeps in. Stocks might still climb on momentum, but the environment shifts toward caution. Remember 2007? We were at a peak before the Great Recession. Peaks teach us to recognize early signs of potential shifts. Let's dive deeper into these indicators. Capacity utilization measures how much of an economy's productive potential is being used. Above 85% often signals overheating, as factories run at full tilt without room for more output. Inflation might jump to 3 to 5% or higher, eroding purchasing power. The yield curve, which plots bond yields by maturity, inverts when short-term rates exceed long-term ones, historically predicting recessions with remarkable accuracy. It's happened before nearly every U.S. downturn since the 1950s. At peaks, market sentiment can remain euphoric, with stock indices hitting record highs, but underlying cracks appear, like rising inventory levels or slowing home sales. This phase is a reminder of economic gravity. What goes up must eventually level off or come down. Then comes contraction or recession. Growth slows or turns negative, layoffs rise, consumer confidence tanks, and businesses cut back. Stock markets often drop 20% or more. Think bear territory. Defensive sectors like utilities, healthcare, and consumer staples hold up better, while cyclicals like industrials or tech get hammered. Bonds, especially treasuries, become havens as rates fall. For your portfolio, this is stress test time. Diversification becomes evident in its importance. A mix of stocks, bonds, and maybe some cash equivalents shows varying resilience. Contractions widen credit spreads, making corporate bonds riskier, but also highlighting potential shifts. Recessions can affect income streams. Sales or bookings dry up, currencies fluctuate. But it's also when market dynamics reveal opportunities through lower valuations. To expand, recessions are officially declared by bodies like the National Bureau of Economic Research, often after 2 consecutive quarters of negative GDP growth. Unemployment might climb to 8 to 10%, leading to reduced spending and a vicious cycle of cutbacks. Stock declines can be sharp, as in 2008 to 2009, when the S&P 500 fell over 50%. But defensive sectors provide relative stability because demand for essentials like medicine or electricity persists. Bond markets rally as investors seek safety, pushing yields down. 10-year Treasury yields dropped below 1% during the COVID recession. Credit spreads, the difference in yields between corporate and government bonds, widen due to perceived default risks, offering insights into market fear. While painful, contractions cleanse excesses, like over-leveraged companies, setting the stage for healthier growth ahead. Finally, the trough, the bottom of the cycle, where things stabilize before recovery. Unemployment peaks, but stimulus kicks in. Think Fed rate cuts or fiscal spending. Markets bottom out, and rebounds begin. Portfolios often see equities leading the recovery. This is where the cycle resets, emphasizing the value of observation. Troughs are marked by capitulation. Selling exhausts itself, and bargain hunting starts. Stimulus measures, such as quantitative easing or government infrastructure bills, inject liquidity, sparking turnarounds. Equities typically bottom before the economy does, as forward-looking markets anticipate improvement. Historical troughs, like after the 2009 financial crisis, saw massive rebounds, with the S&P 500 tripling in the following years. This phase underscores resilience and the cyclical nature of economies. So, how do these cycles impact your specific portfolio? Let's think holistically. Business cycles influence asset performance differently across phases. In expansions, equities tend to perform well due to growth. At peaks, volatility increases, affecting risk levels. During contractions, defensive assets gain relative strength. And in troughs, the stage is set for recovery, with markets often rebounding. To elaborate further, portfolios exposed to cyclical assets feel expansions acutely through gains, but suffer in contractions, while balanced approaches smooth out volatility. Understanding this helps in recognizing how macroeconomic forces drive returns without prescribing specific actions. But cycles aren't predictable like clockwork. They're influenced by shocks, pandemics, wars, or tech booms. That's why monitoring leading indicators is crucial. Watch GDP reports. Quarterly growth above 2% signals expansion. Unemployment under 4%? Peak vibes. The yield curve, inverted, short rates higher than long, often precedes recessions by 12 to 18 months. Data enthusiasts can use tools like FRED from the St. Louis Fed for free charts. Predictive metrics are key in understanding these patterns. Beyond basics, leading indicators include the Purchasing Managers' Index, PMI. Above 50 indicates expansion in manufacturing or services. Consumer confidence surveys from organizations like the Conference Board gauge sentiment, often peaking before economic tops. Housing starts and building permits foreshadow construction activity, a key economic driver. These tools allow for a data-driven view, helping dissect cycle stages without guesswork. Add a layer for international exposure. Currency considerations come into play. Business cycles aren't just U.S.-centric. Global sync-ups mean a U.S. expansion can lift emerging markets, but local contractions, like in Europe amid energy crises, can create drags if unaddressed. Use Forex ETFs or options to observe mitigation effects, and tie it to taxes. In certain scenarios, tax considerations during booms can play a role in overall financial dynamics. Globally, cycles can desynchronize. China's growth might buoy commodities while Europe lags. Currency fluctuations amplify this. A strengthening dollar in U.S. expansions can hurt multinational earnings. Tax policies, like changes in capital gains rates, interact with cycles, affecting net returns in booms or busts. Let's drill deeper into observations. In expansions, markets show strength in growth areas, but cautiously, as liquidity remains key. Track cycles through data. Spreadsheets can log metrics like returns and benchmarks like the S&P for comparison, useful for understanding performance. Data tracking might involve charting moving averages of indicators or using correlation analysis to see how assets move with cycles. Risks: overconfidence in expansions leads to bubbles. Fear in contractions causes panic. Behavioral finance highlights this. Emotions drive reactions. Geographical diversification can capture global cycles, showing how interconnected economies are. Behavioral economists like Daniel Kahneman explain biases like herd mentality, where euphoria at peaks inflates assets, or loss aversion in troughs prompts undue selling. Historical context helps. Post-WBW, U.S. cycles averaged 5 to 6 years, but globalization shortened them. The 2020 COVID trough was swift due to stimulus. 2022 to 2023, inflation peak-tested bonds. Today, in 2026, watch AI-driven expansions. Tech stocks could boom, but supply chain kinks from geopolitics might trigger contractions. Looking back, the dot-com bubble peaked in 2000, leading to a mild recession, while the oil shocks of the 1970s caused stagflation. In 2026, emerging tech like AI could extend expansions, but risks from trade tensions loom. Wrapping up, mastering business cycles isn't about timing perfection, it's about understanding positioning. As someone with hands-on experience in quantitative portfolio management, trust me, this knowledge informs perspectives. Questions? Drop them below. Subscribe for more. like next on monetary policies. Thanks from Nomad Finance Hub.